inflation is yesterday's problem.
Mm-hmm.
That is a load of rubbish. The real driver of the loss of purchasing power of a fiat currency is the budget deficit. And the budget deficit in America, for example, I mean, it's funny enough, I've just put this together for an article which I'll release tomorrow. But if you look at the budget deficit, that is by far and away the most important definer of the loss of purchasing power of the currency. I mean, we're looking at something like 9% of GDP. By my calculations, going back, because you've also got to factor in changes in the, in the volume of savings and things like that. Mm-hmm. And also you've got to factor in non-productive lending, which is basically the increase, if you like, of credit card debt and so on and so forth. It's all that non-productive credit going into the economy. And that I reckon on my numbers is about 9%. If you get taking the second half of the last fiscal year and the first half of this fiscal year. Now that inflation is in the pipeline. Now, is it going to go down next year? No, it is not. And the year after? Certainly not. So the idea that inflation is yesterday's story is, I'm afraid, wishful thinking. I would very, very strongly argue that the evidence is that markets will take control of bond yields in particular, bearing in mind that the US government has something like 130% debt to GDP. It will find itself paying higher yields in order to secure its funding, not lower yields. The effect on companies, zombie companies, will be to drive them out of business. The effect on banks will be substantial increases in non-performing loans. We're already seeing this with the commercial real estate sector, for example, which has sort of wiped out, looks like it's wiping out about half total US bank equity. Ways in which this can be handled, but it ends up with exactly the same result, which is not good. I mean, the one is that the Fed lets the market effectively lead it by the nose in terms of its interest rate policy, mm-hmm. and that way secure the purchasing power of the dollar. It decides that it's got to abandon the rate of the dollar and really look internally to try and prevent business failures in the domestic economy, banking failures in the domestic economy, and all the rest of it. And, I mean, I'm sure in the Fed, there's still people who believe that if you've got a healthy stock market, then that gives confidence into the economy, and that's a very important part of the whole picture. Now, under those circumstances, then you can kiss goodbye to the dollar's value on the international exchanges, changing differentials perhaps between the dollar and the euro rates. I think really, this would really be shown up in the value of the dollar measured against the value of gold, because we're comparing a fiat currency which is getting into credit difficulties with real, legal, no counterparty risk money, which is gold. Mm. So, this again, this is a crisis which is playing into higher gold prices measured in dollars, I'm afraid.
The narrative that inflation is yesterday's problem is, to put it bluntly, a load of rubbish. The real driver of inflation, or rather the loss of purchasing power of a currency, isn't just the transitory economic noise. It's the government's budget deficit. Now, you might be wondering, how does a budget deficit connect to inflation? Let's break it down. The US budget deficit is currently running at an astonishing rate, approximately 9% of GDP. If you factor in changes in savings volume and other dynamics like non-productive lending, think credit card debt, it paints a stark picture. This deficit is the most significant contributor to the loss of purchasing power because it means that the government is continuously spending more money than it earns, leading to more debt and, eventually, more money printing. Let's not forget all that non-productive debt, the credit cards, the consumer loans. They're like putting fuel on the fire. It's debt that isn't creating new wealth or productive capacity. Instead, it's just fueling consumption, pushing more money into circulation without adding any real value to the economy. In other words, we're inflating the money supply without actually producing more goods and services. That's a classic recipe for inflation. The idea that inflation is under control and might even go down next year? Let me tell you, that's wishful thinking. Inflation is firmly in the pipeline, and it's not going anywhere. We may see temporary dips, but the trajectory over the coming years is clear. It's upwards. Just consider the dynamics. With deficits ballooning and governments reluctant to rein in spending, we're only setting ourselves up for a prolonged period of currency debasement. Think about it. The U.S. government's debt to GDP ratio is at 130%. It's getting harder and harder to finance this debt, and it will only get more expensive as interest rates rise. The market will inevitably take control of bond yields, and that's where things get ugly. The government, in its struggle to secure funding, will have to pay higher yields. That's bad news for everyone holding U.S. debt, and it's especially bad news for companies teetering on the edge, what we call zombie companies, that can only survive in a low-interest environment. And let's not overlook the banks. Higher yields mean more non-performing loans, particularly in sectors like commercial real estate, which is already wiping out a significant portion of U.S. bank equity. We're talking about cascading effects that could impact every corner of the economy, from small businesses unable to refinance loans to banks struggling to maintain solvency. So how does the Federal Reserve handle this? They're really stuck between a rock and a hard place. One option is to let the market lead them by the nose, allowing bond yields to rise and potentially securing some purchasing power for the dollar. But this comes at a cost. It will lead to business failures, banking crises, and an economic slowdown that no central banker wants on their watch. On the other hand, the Fed could choose to support the domestic economy, cutting rates, propping up the stock market, and trying to foster confidence. But this would mean abandoning the dollar's value on international exchanges. The choice between domestic stability and maintaining global currency credibility is a no-win situation. Let's not forget the fallacy some at the Fed still believe, that a healthy stock market means a healthy economy. If only it were that simple. Propping up asset prices does little for the real economy when purchasing power continues to erode and living costs rise faster than wages. It's a classic illusion, a bubble that looks good on paper but bursts as soon as reality catches up. So why should you care about all of this? Because silver isn't just an investment. It's a once-in-a-lifetime opportunity to buy an undervalued asset at a time when the fundamentals are screaming for higher prices. It's not just about supply and demand. It's about the geopolitical shifts that are taking place, the de-dollarization movement, and the way countries around the world are positioning themselves for a future where the US dollar isn't the world's reserve currency. And if you think that the price of silver can stay this low forever, think again. Once the manipulation breaks, and it will, silver is going to explode higher. When that happens, the people who had the foresight to buy in while it was still cheap are going to be the ones who come out ahead.
That's a very interesting point because we've known for a long time that physical bullion has been migrating from west to east. China basically has absorbed an awful lot of gold, both the state with hidden reserves and also the people. Since the Shanghai Gold Exchange opened, somewhere around about 26 to 27,000 tons of gold has been withdrawn from the exchange's vaults, and that goes into jewelry and also bullion stored outside the system. And on top of that, there is bullion stored within the system, whose beneficial ownership is Chinese citizens through their bank accounts. So the demand has been enormous. Now, it is beginning to accelerate, and it's a number of unfortunate events seem to be coming together. The first thing to appreciate is that China's household savings rate is 35% of its GDP. Now, 35% of China's GDP is the equivalent of $6 trillion. So you have to ask yourself, where do those savings go? Well, property, it used to go a lot into property. I mean, basically, they used to, for the pension fund, quote unquote, they would just buy off-plan apartments in high-rise buildings in these new cities. And you just buy them and you just sit on them. I mean, they, maybe empty, maybe put a relative in it or whatever eventually. You use it if you visit the city. But basically, that game is over. Property prices are now falling. We know that the whole of the construction industry is in dire straits in China. So what else? Well, there's the stock market, but the stock market has been a bit better this year, but that is after 3 years of bear market. Now, I can see some of the household savings going into stocks, but very, very limited, because you're not going to get the bullishness that you would associate, let's say, with the healthy market. So that's out. And this is why the $6 trillion, the bulk of it, goes into what are called certificates of deposit. Now, a Chinese certificate of deposit is basically a 3-year fixed deposit for individuals. And it's been going into those really for the lack of anything else. Now what's happening is that people are beginning to buy gold. So that 35%, $6 trillion equivalent, a fairly large portion of it is beginning to overhang the physical gold market. The reason that this can accelerate very quickly is that all Chinese banks offer gold accounts as well as ordinary yuan deposit accounts. Now, all you need to do is have the equivalent of about $70 in order to open one of these gold accounts. So it's a situation where now that prices are beginning to rise, going into new high ground, it's produced a sort of dichotomy in terms of behavior. In the West, until very recently, people took the advantage of these high prices, quote unquote, to sell their gold because they've been sitting on it for so long, and whatever. Anyway, they think, oh well, we'll
just
get
a
out.
pet rock for them.
Yeah, but Tom, this is the sort of behavior that happens at the bottom of a bear market, and yet we've got it going into new high ground. But the Chinese households are taking a completely different view. They're seeing the price of gold in yuan rising, and they're thinking, we better have some of that. So you can see that there's a beginning of a stampede going into physical bullion, even after something like 27,000 tons of gold has already been acquired by the public in China. So this really is going to drain all the physical liquidity, so far as I can see, out of the West. And this is why the gold price is rising and rising and rising.
Now let's talk about gold. Historically, gold has been the canary in the coal mine for economic mismanagement. When people lose faith in fiat currencies, they turn to gold. Why? Because gold is real money. It has no counterparty risk. It doesn't rely on a government promise, and it's been a store of value for thousands of years. The price of gold measured in dollars is going up. And this isn't just a blip. It's a reflection of the crisis in fiat currencies. We're comparing a currency, the US dollar, that's drowning in debt with gold, an asset that holds its value regardless of government policy. And that's why gold prices are rising and will continue to rise. Let's look at the trend over the past few years. Physical gold has been migrating from west to east. Since the Shanghai Gold Exchange opened, around 26,000 to 27,000 tons of gold have been withdrawn from its vaults. This gold goes into jewelry, bars, and bullion, most of it held outside the formal banking system. On top of that, a large amount is held within the system, owned by Chinese citizens through their bank accounts. This isn't just a trend, it's an acceleration. China has a household savings rate of 35% of GDP, equivalent to about $6 trillion. Historically, much of this money went into property. People bought apartments as a form of investment. But with property prices now falling and the construction industry in dire straits, people are looking for alternatives. The stock market isn't providing the returns or the stability that investors want. So where does that money go? Increasingly, it's going into gold. Here's the fascinating part. All Chinese banks offer gold accounts alongside regular yuan deposit accounts, and it takes as little as $70 to open a gold account. So as the price of gold rises, more and more people are choosing to move their savings from yuan into gold. This shift is a game changer for the global gold market. We're talking about trillions of dollars that could potentially flow into gold, and that's enough to drain the West of its remaining physical gold reserves. This is the reason why the gold price keeps climbing. While Western investors are selling their gold to cash in on high prices, the Chinese are buying. They're not just buying because it's shiny, they're buying because they understand what's coming. They see the value of their own currency falling, and they know that gold is the best way to preserve their wealth. In the West, people are still thinking in terms of yesterday's market dynamics. They see the price of gold going up and think it's a good time to sell. In China, people see the same rise and think it's time to buy more. It's a complete reversal in mindset, and it's going to have a profound impact on the market. Let's not beat around the bush. Western investors are asleep at the wheel. The media narrative here is that inflation is under control, interest rates will stabilize, and everything will go back to normal. But what they fail to realize is that the very fabric of the financial system is changing. China, India, and other Eastern nations are taking advantage of the West's complacency. They're buying up gold and silver, taking physical delivery, and storing it away while Western institutions continue to play with paper contracts and derivatives. And these Eastern nations aren't buying precious metals because they think it's a good short-term investment. They're buying because they know the inherent weaknesses of the fiat system, and they are positioning themselves for the long haul. Let me give you a stark example. India. In the first 6 months of 2024, India imported 5,554 tons of silver, a 7-fold increase over the previous year. That's a clear indication of strategic accumulation. And yet, in the West, we have institutions over-leveraging and suppressing silver prices to keep it artificially low. These Eastern nations understand a fundamental truth. He who holds the gold and silver makes the rules. They are not interested in ETFs or paper promises. They are standing for delivery, and they are taking the metal off the market. We are witnessing a massive migration of wealth from West to East. And it's not just in the form of physical gold and silver. It's about control of the future global financial system. The BRICS nations, Brazil, Russia, India, China, South Africa, are leading the charge, working to create a new financial infrastructure that is less dependent on the US dollar. These nations are tired of being subject to the whims of Western monetary policy. They are tired of their savings being eroded by inflation exported from the United States. So, they are taking matters into their own hands, building a system that is more stable, more reliable, and backed by something of real value. The message here is clear. Prepare yourselves. The signs are all around us. The East is buying, the West is selling, and the power dynamics are shifting. This isn't just about making a profit. This is about protecting your wealth in a world that is becoming increasingly unstable. Before we wrap up, let's talk briefly about silver. While gold gets all the headlines, silver is quietly positioning itself as the most undervalued asset in the world. As I mentioned earlier, India has been buying massive quantities of silver, and they're not alone. Silver has unique properties that make it indispensable, not just as a monetary metal, but also in technology, healthcare, and renewable energy. And here's the kicker. Silver is being consumed faster than it's being mined. The solar industry, the tech industry, and even the military are all massive consumers of silver, and yet prices are still being artificially held down. But like a coiled spring, once it starts to move, it's going to move fast. Imagine a scenario where silver breaks through $50. The psychological impact alone would bring in a wave of new investors, pushing prices even higher. And unlike gold, which is often held by central banks, silver is primarily held by private investors and industries. That makes it a lot more susceptible to a sudden squeeze in supply. So what's the takeaway here? The world is changing, and the global financial landscape is shifting. The East is accumulating gold and silver, understanding their value in a world of depreciating fiat currencies. Meanwhile, the West is asleep, lulled into a false sense of security by a Federal Reserve that is running out of options. The best opportunities are the ones that most people don't see. Right now, gold and silver are those opportunities. Don't wait until the headlines are talking about gold at $5,000 or silver at $100. By then, the real opportunity will be gone.